All right, folks, welcome to Investing for Beginners podcast. Today, we're going to answer three great listener questions, and then we're going to have a little discussion about something that's going on in the news. So stay tuned. That will be fun to hear. So first question, let's just kind of dive right in. So we got, hello, Dave. I'm starting from the beginning with the podcast. I'm about 15 episodes in from the 2017 episodes. Unfortunately, I began investing in some stocks a couple years ago before I discovered your podcast and made some not so great decisions. I have one stock that I'm down over 40% and another I'm down over 60%. My question is, at some point, do I cut my losses and just sell, or do I try and buy additional shares at lower price points to try and bring down my average cost per share and sell when I'm closer to the stock price? I know waiting to break even is impossible at this point, so I don't want to tie up that money when I could be investing in better stocks. So a great question from David, easy name to remember for me. And Andrew, why don't you take the first stab at this one?
Yeah, thanks for writing in, David. Welcome. And I'm glad you're finding the podcast helpful and useful. It's a great question. I think we all come across this crossroads at one point or another. Because if you're going to buy stocks, there's going to be a time when you're going to be down, and you'll probably be down a significant amount, enough to make you feel like, why did I do that? That's just inevitable. What I'm kind of interpreting, and I could be doing it wrong, we're not face to face, obviously, but it sounds like you're looking for an excuse to get out of these companies. I think you want permission to sell and move on with your life, and I wholeheartedly give you that permission.
Why are you giving him the permission, and what could he learn from this experience?
Well, I mean, it's spilled milk. You know, David, you mentioned you have a stock that you bought before you discovered our podcast, before you took the time to educate yourself. And it's highly possible that this was stocks that were bought with less skill and less knowledge than if you bought something today and maybe pick something new today. Maybe you have that more advanced skill set, that more advanced knowledge, and find better stocks to pick from here out. So that is, I guess, something you do want to be careful about, because we're always ideally going to be getting better and better at what we do. So you are going to buy things that hopefully in 5 years you'll still want to hold, but you haven't given us any reasons why you want to hang on to it other than to make money from it. That's usually a bad reason to do things, just because I want to make money from it. We understand you lost some money. You want to see that red go back to a positive number. But at the end of the day, if you're following the investing for beginners approach, you're buying stocks not just to make money, but because you're trying to be an investor, a long-term investor in a business that is well run and that we expect to continue to grow. And so to have that kind of mindset, it's not natural, but you have a mindset where you are a owner of a business rather than a stock speculator or somebody who trades in and out just to make a quick buck. The reason why we do that is because that is a better, longer lasting way where you have a better chance of having sustainable success. And the losses you took so far on these stocks, the question, do I cut it, or do I just move on, or do I add more? None of those things sound like an investor is talking. I would rather hear, what business is this? Why is the stock down? And what is that telling us about the business? And has that changed? Has the outlook for the business changed? Those are the questions I try to ask myself when I'm looking at the stock I own that goes down big, rather than, do I try to make the money back? That's not going to give you any sort of fruitful discussion in your brain about making a good decision. So to me, try to act like an investor, and we all make mistakes, so just move forward from it. And spilled milk is spilled milk. That's kind of how I see it.
Mm-hmm. Yeah, exactly. Spilled milk is spilled milk, and you can't get back the decisions to invest in those companies. But to Andrew's point, you can learn quite a bit about the decision-making process. I read something earlier today, whether or not I haven't verified if it's true or not, but it didn't sound out of whack, is that the average retail investor spends a grand total of 7 minutes doing research on investing before they invest in a stock. And most of that revolves around the time it takes them to pull up a price chart to see how a company is doing. And hopefully we have learned to move beyond that level of depth of research. And I think what Andrew said is the right way to think about it. You need to think about it as a business owner. You're buying a business, you're not buying a stock. And I think if you can try to reframe the questions that you're asking us and learn from the air quote mistakes of buying those companies. If you did 7 minutes of research to invest in those two companies, why did you buy them? And take this opportunity to learn about the business and what is going on with the business. Is there a reason that it's down 40 to 60% for each company? And if it's business wise, that makes sense, then you learn something. And that's something that can help you in the future when you buy the next two companies that you invest in. And I love that idea of trying to be a business owner. And I think if our good friend Warren Buffett, he's not actually a friend, but our mentor, guidance, grand poobah, whichever adjective you want to describe, if he's told us nothing, if we learn nothing from him, is that investing is the best way to do it is to look at it as a business owner. And if you look at it that way, it reframes everything that you do when you buy or sell a company. And that helps answer, it also helps answer a lot of the questions that you're asking. You know, there are times when a company is down 60% and the tide has gone out, but it doesn't mean that that company's performance has gone out. And so that could be a great opportunity to invest in said company. So that's the way I would try to look at it, David, is to look at it as a learning opportunity and try to reframe the question. And I think if you do that, then I think you'll learn a lot. And I also give you permission to sell as well. So you have our blessing, you can move on. Hopefully that helps. All right. So let's move on to the second question. So this is a fun one. So this is from Reddit. Do you ever reduce your estimated starting free cash flow number? What I've learned reading content from Aswath Damodaran and Michael Mauboussin is that even free cash flow can be subjective, and many companies need unique case-by-case cash flow adjustments to get to a more accurate number. So what are your thoughts on this? Like, how do you approach free cash flow estimating it, and do you ever reduce it as opposed to increase it?
I'm wondering if that was your burner account asking that question.
I'm not on Reddit, but it does sound like something I would say.
Absolutely. I reduce the estimated starting free cash flow number. And a good example of that is stock-based compensation. When I'm trying to do a DCF, when I'm trying to figure out what the valuation of a company is, I'm trying to do it from the perspective of I'm buying stock, I'm buying a piece of the business, but how much is that stock going to be worth over the next, let's say, 10 years? So if a company, like a tech company, you could even say Google or Meta are great examples, even Microsoft, a lot, billions of dollars that they essentially pay out in stock to their employees makes its way onto the financial statements as stock-based compensation. They make more money than that from their businesses, obviously, in cash flow. What they do to offset that stock issuance is they buy back stock with their profits. So if I'm a shareholder in, let's say, Meta, and I'm looking at the company, and the company is showing cash flow of, I haven't looked at their numbers lately, I don't know, like $80 billion or something. But if I know that their 15 billion is going to be used just to buy back, just so that they don't dilute the company, why would I count the whole 80 billion? If it's going to be something they're going to do year after year after year, I mean, are you just going to stop giving stock options to the employees? Yeah, I mean, that's possible, but in a healthy, good environment, maybe they're continuing to dilute that. So maybe even though on the accounting basis you're getting 80 billion, if they're really having to buy back 15 billion every year, you're not going to see that as a shareholder. And so we're buying stock because we're trying to get the cash flows that the business is generating and allowing the business to do things with it. But if it's not really cash flow that they can use and it's actually being tied up in this thing that they do every year with stock-based compensation, then I would not. So I would reduce the starting free cash flow number by the stock-based compensation because I'm trying to figure out how much cash do I think shareholders will be able to be accounted to them. And it's all fun and games because it's all theory, and it's not like actually 65 billion is going direct to shareholders and that's why the stock price goes up 15%, blah blah blah. Like, it's a very academic exercise, but that's the way I like to think about it. What about you?
Yep. Yeah, I agree 100%. I think when you're calculating free cash flow, the easy answer is you take operating cash flow and you subtract capex from it, and that's how you get a free cash flow number. But it depends. You kind of have to take it case by case. And if you're dealing with Berkshire Hathaway, for example, who doesn't pay stock-based compensation, then trying to reduce it by that is kind of pointless. But if you're looking at, to Andrew's point, Meta and Microsoft and Google, it's very important. That is actual money that's reducing the amount of free cash flow that shareholders will receive if the company uses it to give us a dividend or buy back shares, for example. And so one of the things that Meta has received criticism for, and you can argue both sides of the coin, is that they have spent a lot of money buying back shares, but it really hasn't reduced the number much because of the amount of stock-based compensation that they paid. Now, the argument on the other side of that is that Meta has to do that to remain competitive because of in their industry, that's one of the ways that they can attract talent to come program all the great stuff that they're trying to do. So there's pros and cons to each side of it. But I think the thing you need to think about is kind of twofold. Number one is you definitely need to take it case by case. I think just doing the simple free cash flow that I just mentioned is a great place to start, and then you can move depending on each company. Another thing that I like to do in adjusting is looking at companies that are acquisitive. So, for example, if you're looking at a company like Danaher or Thermo Fisher or Constellation Software, these companies, a big part of their business is buying other businesses. Some in cases to grow the business, in other cases to acquire technology or products that it's easier for them to buy than to make themselves. If you have companies that are consistently doing that, I like to adjust that out of the free cash flow as part of my process. Now, the trick with that is that these companies generally consistently will purchase or acquire other businesses. The trick with that is that there are some companies that will occasionally make an acquisition. And in that case, then I would not adjust it because it's not a norm for them. It's obviously something I have to take into consideration, but if they don't make another acquisition for the next 5 years, then I'm adjusting too far down, then I would probably try to normalize that number or basically take an average of the numbers to make it a little more air quote consistent. But I strongly agree that you need to do it on a case by case basis. And I think it's fine to generalize, but I think if you're going to specifically look at Meta and you're going to specifically look at Danaher, you have to treat those differently because they're two different businesses and the way that they operate are different. So you have to kind of think of it that way. And that can help avoid being, I guess, overly bullish and also overly bearish. And I think it's very normal to reduce the free cash flow number as opposed to being always bullish. But what do I know?
I wish it was normal. That would be the logical thing to do.
So do you, like, if you're looking at Nike, do you approach that differently than you would approach looking at Google?
Yeah, I mean, the whole case by case thing is really, I know it sounds like a cop out, but it really is super relevant when you're talking about free cash flow. And another good example, I think, of adjusting free cash flow that needs to be done, because if you don't, you're going to think every cyclical company is a bargain, but you need to adjust margins and you need to normalize it over a long time period. So if you have a company like a home builder where when home building stocks are booming, their profits are huge, but then they also crater when housing is not doing well. If you're not adjusting for that, then you're being very optimistic about the future of their free cash flows. So to use the idea of Nike, from my understanding, they grow more so from working capital than somebody like Google would. So yeah, I would look at them differently. And the thing you want to look for in a company like that, and it applies to retail, it applies to distributors, those type of businesses, is look for, if we're calculating free cash flow using the cash flow statement, look for how changes in working capital are changing. I wanted to think of a different word for that, but how changes in working capital are changing from year to year. And so if it's kind of lumpy in the year you were looking at, then adjust the free cash flow so it looks more normal. As long as you believe that whatever they did to make that number lumpy did not change the long-term outcome of the business. If Nike went and bought a bunch of dollar store sandals in their inventory, and that's why their inventory, their change in working capital is minus 8 billion, then yeah, maybe I'd be a little more concerned and I would not adjust. But those are the things I think that's also important. Don't just adjust to adjust, but try to put some thought into, why am I making this adjustment and does it make sense in this case?
Yeah, I think it stems. It goes back to understanding the business and how their operations work. And I think if you can get your head around that, I think it helps a lot when you're trying to figure out how to make any potential adjustments to something like a free cash flow.
Yes. The best stock picks require a light bulb moment. To see exactly what that looks like, check out one of my previous reports at stockwriteup.com.
All right. Well, let's move on to the next question. So we got Andrew and Dave. Good afternoon. My name is Maurice. Last spring, I came into a substantial amount of money through an inheritance. In one of your newsletters, I came across the gentleman Ronald Reed. To put it simply, he is really my overall goal. Build a wealth portfolio with a nice dividend income to support me and the missus. As far as my investments now, he has a 401k with my employer, max contributions in 2025. Has a Roth IRA maxed out accounts, wife also. Stocks, bought some 4 years ago, but clearly didn't know what I was doing. Will need to reduce the number. I currently have about 15, but looking to get rid of some of the earlier purchases, which will cut it down to 10. The questions, if you were in my shoes, what investment moves would you look to make, or advice would you share on things I might need to be investing in at this point, i.e. bonds, ETFs, more stocks, or further in the stocks I currently own, which are Apple, Walmart, John Deere, Wells Fargo, Procter & Gamble, to name a few. So he's looking for how he should handle his portfolio and trying to build long-term wealth while he's also has a nice 401k and Roth IRA contributions as well. So what are your thoughts on Maurice's question?
Yeah, thanks for listening. I think it's awesome that you say that the podcast is helping, and keep on keeping on. You are absolutely killing it with max on the 401k, maxing out the Roth IRAs. You've given yourself plenty of margin to make some boneheaded stock choices, and you're going to end up a lot better than probably a lot of us. So good job. That's the hardest part of the game. As far as having stocks you're not happy with, this is something, it seems like it's the trend for the episode, huh? Like we all buy stocks, and one of the things I would like to claim this for myself. I would like to pretend that I was the very first one to think of this, but the honeymoon stage of buying a stock, we all get that. And then after a certain amount of time, you start to see the business for more kind of where it really is, and the stock for more where it really is. For me personally, it kind of goes through this like, how is not everybody buying this stock? I am buying it at the very best time in the history of buying this stock, to like, oh, I think I kind of start to see why people are staying away, to like, did I make a mistake here? And then the cycle repeats, right? So do you have thoughts on when you have a portfolio that you look at and you're just kind of like, oh, how to navigate that?
Well, yeah, that's a great question. I guess I guess the thing I would probably start with is he mentioned that he had 15 companies and he wants to cut it down to about 10. And I guess the first thing I would probably try to do are, what are these businesses? What are the businesses that I own? And of these 15, which do I think have the best air quote potential to be better investments now, 5 or 10 years from now? And if all 15 are equal, then then it becomes a lot harder to question. But that's what I would do. And then I would rank them by what I think are the highest quality ones to air quote the lowest quality ones. And then I would probably start at the bottom and look at the ones that I think are the worst quality and try to figure out, are these worth me keeping and why? Like if I want 10, why do I want 10? And would I be willing to cut loose any of these based on the quality of the business? And then try to determine, what do you think are the ones you absolutely want to keep, maybe not sure on, and then ones for sure that you think, okay, this is maybe not a great business. And that's how I would try to look at it. What are your thoughts? How would you attack this problem?
Yeah, I agree. I did something similar in 2020 when I kind of pivoted away from deep value into something that's more of a growth value hybrid. And that was definitely something, you're comparing what kind of future do I see for this business or that business. And yeah, I think that's a prudent thing. I'm going to back up though and kind of like put the brakes on, because I just realized that in this question, Maurice had a pretty big reveal in the question. He says he came into a substantial amount of money through an inheritance. I'm going to ask, how many inheritances do people get in a lifetime?
I guess is one, if
Yeah.
any.
So I hate to kind of give that kind of a mindset of like, you can't screw this up. But we really, if you're getting a substantial inheritance, that's awesome. Like, you're already pretty lucky to get that. But it is your one shot. So let's be realistic there. If you are just learning how to stock pick and you're not, maybe you may or may not feel comfortable with the idea of stock picking, I would highly recommend just like going to a financial advisor or learning about passive investments and ETFs and things like that, and taking the potential for blow up as far away from your hands as possible. I think a lot of the questions we get, and the first question was a great example of this, oh, it was $200, $280, whatever. That is like somebody just starting out, going to build slowly over time. If you have a one shot with your inheritance, I would not recommend learning how to stock pick using your one shot. If it was me personally, I had a massive inheritance and I was just starting the very first time with this, I would take maybe a small portion of that and then try to grow my skills. And that's probably going to be really hard to do. That's just me. I would treat it like it's a one shot and kind of look at the stock picking in its own bucket.
Mm-hmm.
As far as making the transformation itself, I like the idea that when I was doing this transformation, and I did it during COVID, by the way, so the sense of urgency was massive. Dave told me that you're not going to become Warren Buffett overnight, and really the reality was I didn't have to transform my portfolio overnight. So that's what I did. I did 1 month at a time. Sometimes there would be multiple stocks I would sell, but that's what I did. One month at a time, company by company, my portfolio got better and better. And I think that's a good mindset to have, because, there were some stocks that were thrown in there. That's a pretty big list. And so are you going to become expert in all 5 tomorrow and then you're going to make the decision? Or is it better to maybe space out some of that decision making? So that's some of the things that, not really fun to talk about, not really great on the vibe scale, but those are all things that I think if you take them into consideration, take your time and try to be prudent with some of your decision making, I think you'll be happy you did. Eventually.
Yeah.
Maybe not tomorrow.
I think yeah. I think that's great advice. I mean, I kind of glossed over that, but that's really a critical part of this whole discussion And the fact that he's maxing out the 401k and his Roth gives him additional cushion to be patient with himself to as he evolves to become the next Warren Buffett. He could take his time. It's not a race. And I think that gives him a lot of cushion to be able to take the time to learn what he needs to know to make the decision he's asking about. And the other part of it too is the companies that he listed, at least the five that he listed, are not the types of companies that are necessarily going to blow up your portfolio either. So they're not necessarily like hugely risky, growthy kinds of companies. And if the rest of the portfolio is similar to that, then that also gives you a more cushion. You know, if you have things like Johnson and Johnson and stuff like that in Coca-Cola and other things like that, none of those are going to lose you every penny you have because they're not that kind of investments. And so that I think that affords more time to do the work that you need to do to get to that point. And then the other part of it too is your life has probably changed dramatically because of this. And maybe this won't be as interesting to you 2 or 3 years from now. And you may just decide to outsource it and call it a day and go enjoy your life. And there's nothing wrong with that either. So I think Maurice is in a really good position for sure.
Yeah.
All right. So now we arrive at the question of the day. So in the news, there was some not so favorable news potentially about Google. One of the, I'm not sure his position, but one of the managers at Apple revealed that he was observing a downturn in search, which relates to Google. And there's already a lot of fear on the horizon about AI and Google search and how that's all going to be impacted. So the company drew down that day 7-8%, whatever it is. And there's still a lot of, I guess, fear and anxiety about Google and lots of speculation that Google search is dead and the company is toast and all that stuff. And so Andrew and I are both shareholders of Google. And so I thought it would be interesting for us to discuss kind of how we're approaching that news and just general thoughts on how to react to news in general.
Well, I'm going to give everybody deja vu. It's going to be like the discussion last week. AI is I think the disruption risk of AI seems to be overblown. And I'm going to give a super techie, super deep dive, like I can't even pretend to speak intelligently about this, but I bought one of the newer iPhones and I'll be honest, like I just wanted that color thing that you saw in the commercials where it like lights up your screen. I wanted it. So I got it. I know it's very techy. But when you use, so I started playing with asking it things because I never really used Siri before. I just never really liked it. But they have the button now, so Siri doesn't have to listen to you the entire time. So I was playing with that, and a lot of times it asks you after you ask the device a question. It'll ask you, seems like you want to search that. Would you like to search it on Chat GPT or would you like to search it on Safari instead? Or search on the internet or whatever it was. I don't know. But it always like defaults you on Chat GPT. You already know where I fall. Which button I press on that. That's no secret to anybody. But like, could that have been the reason that the new iOS people using Siri, like I haven't followed the news, so I don't know if that's something people are talking about already or not. But like, that's a big kind of like, hello, like, can we talk about that part too? And has that play the role? So the whole thing just kind of, it grates me the wrong way a little bit, just because again, we're declaring a victory based on. I was watching TV and people were commenting about this, and It's like, well, I use this or I use that. I use this AI to search or I use that AI to search. It's like, I don't care what you do. Every person who seems to be screaming disruption talks about what they do personally. I'm like, you
Mhm.
are such a small portion of the internet. I don't know. It just drives me. It raises the blood pressure like a degree, and so it's like, come on, like honestly, the reaction that it gives me is I want to put a quarter of my portfolio on Google and just let's
Double
see where
down.
we're at in 10 years. Let's go, but unfortunately I'm too risk averse to do something that bold. I'm
Mm.
like, maybe I'm wrong. Okay, I'll keep it a full position size, and that's how bold I'll get. But really, I really believe it's overblown, but who knows?
Yeah, it's going to be interesting to see how this is all going to play out. I think there's no question that it's overblown, and I think that the the use of AI, in particular with Google search, if you go on Google now and you type in how many how many boats did Christopher Columbus use when he first discovered America, you're not going to get the old days where you would get 5 or 6 or 10 articles with blue links kind of thing. That's pretty much gone now. Pretty much every question you get is going to be like the AI summary at the top with links to the articles and blah 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 blah, which is fine. But the trick is, there's two tricks. Number one is, a lot of people, when we're going to Google to ask a question like that, is we want a simple answer. I don't want 10 links to figure the answer out. So that part of it is nice. But the trick is that you're not always sure it's giving you the right answer. So then you have to additionally click the links and determine if those articles are legitimate enough to answer the question of how many boats did Christopher Columbus use. So it gets a little more cumbersome. Will that be like that for the next 5 years? Probably not. But for now, that's kind of what you got to deal with. So to me, it's not as great a user experience as it was a few years ago. And so there's that part of it that's kind of a challenge to navigate. The other part of it is that I think people always want to be the one that can declare, see, I told you Google's dead. Or Apple is dead, or Microsoft is dead, or Visa's over. There's always people that want to declare something is over because they see something that maybe that's what they want, and they are short Google, or they bet big on Amazon and they want Google to die because that'll make Amazon a better investment. People are always looking for the disruptor, and sometimes there's certainly disruption on the horizon. And I'm not saying that AI is not going to replace it. Very well may. I don't know, but I think it's too early to make a judgment on that. And then I read a couple things online today about this kind of topic. One was very bullish and one was very bearish. So the bullish one was pointed out the fact that they also have YouTube, worth billions, and they also have their cloud slash AI stuff, which is also worth billions, and they also have Waymo, which is becoming a thing now. And so they have all these things, other things going on besides Google search, which is becoming a smaller and smaller part of their business. And so at some point, that may have just become a smaller part of the business as the other parts became bigger. So, this person was pointing out the fact that they still have a pretty powerful lineup, even if Aaron Judge goes down, kind of thing. So they still have a pretty powerful lineup. So I thought was really interesting. Ben Thompson, who writes the Stratechery blog post, probably one of the smarter guys in the whole tech area, he wrote not too long ago that he thinks that the race is really on not whether AI is going to replace search, on what it's more about how well and quickly Google can integrate AI into their search before somebody disrupts them. And he's not picking a side, at least at this point, he said exactly it's one of the most compelling races he's ever watched. So he thinks it's going to be really interesting to see how this plays out. And I probably agree with him. I own Google. I'm not planning on selling it. The news today doesn't make me go, oh, I'm out. It's toast, I just think it's overblown.
Well, I really like what you said, that people want to be able to say that I was the one who said that this and that. One of the things that's equally frustrating, by the way, but it's true about the stock market, is if you want to feel really smart or sound smart, you act negative about it. If you want to make money, you have to be optimistic about it. That's all I got.
Yeah. I mean, it's true. The bears sound smart. You want to sound smart, be negative about a business or something related to the stock market. It's 100% true.
Yeah.
All right. Well, with that, we can go ahead and wrap up our conversation for today. I hope you enjoyed our little rant here at the end. This is something that we will probably be doing more frequently from time to time. So stay tuned to catch our little rants. I'm sure I'll be able to encourage Andrew to go a little deeper on a rant in the future. So with that, we will go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to y'all next week.